Good afternoon. My topic for today is all about investment in equity securities under PFRS 9. So if your equity investment is less than 20%, so it is accounted for under PFRS 9. Initial measurement is measured at fair value plus transaction cost. So the transaction cost directly attributable to the acquisition of financial asset shall be capitalized except in financial asset rather, held for trading or financial asset at fair value through P&L. We have mode of acquisition by exchange or by lump sum. So if it is acquired by exchange, we have order of priority, which is first fair value of asset given. If wala itong number 1, we have fair value of asset received or carrying amount of asset given. So if by lump sum, if 2 or more equity securities are acquired at single cost or lump sum, the single cost is allocated to the securities acquired on the basis of their fair value. We have investment categories. First, we have trading securities or FA, FBPL. So the initial measurement is fair value and the transaction cost is expense outright. Next, we have the financial asset at fair value through OCI. So the initial measurement is the fair value plus transaction cost. We have and next is we have investment in associate, which is discussed in next chapter. Then investment in subsidiary, which is discussed in higher accounting. And then investment in unquoted equity instrument, which is accounted for under cost model, which is the initial measurement and the subsequent measurement is measured at cost. Sale on equity shares. So under PFRS 9, paragraph 3.2.12, the derecognition of financial asset through profit or financial asset of fair value through profit and loss. So if the carrying amount is greater than the fair value, we have loss. And then if the carrying amount is less than the fair value, we have gain and it is recognized in P&L. Cash dividends. So under cash dividends, we have 3 important dates. We have the date of declaration, which is, this is the date on which the payment of dividends is approved by the board of directors. Next, we have date of record. This is the date on which the stock and transfer book of the corporation is closed for registration. So only those shareholders registered as of this date are entitled to receive dividends. Date of payment. So this is the date on which the dividends declared shall be paid. So we have this timeline. So if we have the date of between the date of declaration and the date of record. So if the shareholders sold the share between this date, so we have dividend on, meaning to say the dividends is kasali na siya sa pagbenta mo ng shares. So if between the date of record and the date of payment, we have X dividend. So the original shareholder has the right to claim the dividends on the date of payment. To illustrate, we have a shareholder owns 1,000 shares costing 100,000. Subsequently, the shareholder receives notice of dividends declaration of 5 per share or 5,000. If prior to the record date, the shareholder sales the investment for 150,000, which includes the dividends of 5,000. So the journal entry is cash. Then the investment in shares, which is 100,000, and then the dividends income, which is yung declared na 5,000, and then the difference will be gain on sale of investment. Property dividends. Dividends or dividends in kind are dividends in the form of property or non-cash assets. So it is considered as income and recorded at fair value. So the journal entry is non-cash asset, debit, and credit dividend income. Liquidating dividends. Liquidating dividends represent return of invested capital, and it is not recognized as income. So usually, it is paid from dissolved or liquidated corporation or wasting asset corporation or mining. So the journal entry is cash or other appropriate amount and credit investment in shares. Moreover, when liquidating dividends exceed the cost of investment, the difference is credited to gain on investment. Share dividends. Share dividends are in the form of issuing entities own share. So, let's say yung corporation, instead na magbigay siya ng cash, ang binigay niya is shares. So, it is not recognized as income. Kinds of share dividends. So, we have share dividends of the same class. It is recorded by memorandum entry. So, example of memorandum is received 2,000 shares representing 20% share dividends on 10,000 original shares held. Shares held now or shares now held is 12,000 shares. So to allocate the cost, we have first is the original shares, which is 10,000, and the share dividends of 2,000. So the total share is 12,000. So before, we have 120 per share, which is the total with a total of 1.2 million. Since nag-increase yung shares mo, so you just divide the total cost, which is the 1.2 million, and divide mo siya sa number of shares mo na bago. So the cost per share now is 100. So next is we have share dividends different from those held. As for example, a shareholder owns 10,000 ordinary shares costing 800,000. Subsequently, the shareholder receives 10% share dividends in the form of preference share. The market value of ordinary share is 150, and then the market value of preference share is 100. So In this case, the original cost is um, a portion between the original share, which is ordinary share, and the share dividends based on and the share dividends, which is yung preference na gi-issue based on the market value at the date of receipt. So to compute, we have ordinary shares, which is 10,000 times 150, yung market value niya, and the preference share, which is 1,000 times 100, yung market value. So we have ordinary shares of 1.5 million and the preference share of 100,000. Then it is allocated sa 800,000. So mag-formulate ka lang ng fraction and we have this allocated cost na ang ordinary share mo will become 750,000 and the preference share is 50,000. Share received in lieu of cash dividends. So it is recognized as income and it is measured at fair value, fair value of the share received, or if hindi available ang fair value of share received, we have the cash dividend that would have been received. Share received in lieu of cash dividends. So again, it is not recognized as income. But if cash is received in lieu of share dividends, so we will follow the as-if approach. So we have the share dividends are assumed to be received and subsequently sold. To illustrate, for example, a shareholder owns 10,000 shares costing 1.1 million. Subsequently, the shareholder receives 150,000 cash in lieu of 1,000 shares originally declared as 10% share dividends. So the 1,000 shares representing share dividends are assumed to be sold for the cash received. So we have cash, then cash na 150, and then investment in shares na 1,000, which is yung na-receive mo na 1,000 shares, times mo siya sa 100, which is, yan siya yung original price ng shares, hindi kasi nalagay dito. So we have the investment in shares 1,000 times 100, we have 100,000, and the difference is gain on investment. Share split, we have share split, we have a split up and split down. So when we say split up, outstanding shares are called in and replaced by a larger number. As a result, it is the reduction in par or stated value. So for example, if the shareholder owns 10,000 shares and the share is split up 5 for 1, so meaning yung 1 share mo is magiging 5 share na. The shareholder receives 50,000 new shares in exchange of 10 original shares. Split down. So the outstanding shares are called in and replaced by smaller number. As a result, increase in par or stated value. So for example, if the shareholder owns 10,000 shares and the share is split down 5 for 1. So yung 5 shares mo magiging 1 share na lang. The shareholder receives 2,000 new shares in exchange for 10,000 old shares. Only memorandum entry is made to record the receipt of new shares. Special assessment. So this is usually nangyayari kapag nagkailangan si corporation ng additional investment. So additional capital contribution from the shareholder. So in part of shareholder, it is recorded as additional cost of the investment. Redemption of shares. Shares, particularly preference shares, may be called in for redemption and cancellation by the entity issuing them. So in part of shareholder, it is recorded as sale. Share right or stock right. It is also called as preemptive right. So it is the legal right granted to shareholders to subscribe for a new share issued by the corporation at a specified price during a definite period. So the purpose of this is to preserve the equity interest in the corporation. So one share is equivalent to one right rather. Accounting for share right. The PFRS 9 does not address this issue, but we have the two school of thoughts. Number one, it is accounted for separately, and number two, we have not accounted for separately. Accounted for separately, a portion of the carrying amount of the original investment in equity share is allocated to the share right at an amount equal to the fair value of the share rights at the time of acquisition. Not accounted for separately. So the share right as an embedded derivative is not accounted for separately because the host contract, the investment in equity instrument, is a financial asset. This claim is in the reference for this claim rather is in PFRS 9 paragraph 4.3.3. So again, this is not addressed yet by PFRS 9. So we are still waiting for the Financial Reporting Standard Council and the IASB to resolve this accounting issue. Next, we have the between the date of declaration and the date of record. So we have the right on, which means that the share and the right are inseparable and treated as one. To illustrate, a shareholder owns 5,000 shares costing 500,000. Subsequently, the shareholder receives a notice of share rights to subscribe for 1,000 rights at the par value of 100 per share. Prior to the issuance of the share warrant, the shareholder sells the investment for 750. So we have the cash. We'll debit cash, 150 yung value ng benta mo. And then, investment in share, 500. And gain on investment na 250,000. So if between the date of record and expiration date, we have the X right, means that the right can now be sold separate from the right or vice versa. To illustrate, under accounted for separately, if a shareholder acquired 10,000 shares costing 1.8 million, subsequently the shareholder received 10,000 share rights to subscribe for a new shares at 100 for a share for every 5 rights held. The market value for the share is 150 and the market value of the right is 10. So upon acquisition, we have investment in shares, debit, then cash, 1.8 million. So upon receipt of share rights, we have the share right received are initially measured and recorded at fair value. So ang market value ng share right is 10 and we have 10,000 share rights. So 10,000 times 10, we have 100,000. So as you can see, it is accounted for separately. Binabawasan natin yung investment in shares as we declare the share rights. So if the share right is exercised, so we have the journal entry, investment in shares 300, cash 200, share rights is 100. So the value of shares, a share right is 10 yun kanina, and then dito is if you subscribe a new share, you have 10 no 100 per share rather. So 100 times 10,000. So you have 200. So ang equivalent niya is yun siya 300,000. Sale of share rights. If the share rights are not exercised but sold for 150,000, so the journal entry is cash na 150,000 and share right na 100 and gain. The difference is gain on sale of share right, which is 50. Theoretical or parity value of share right. The theoretical or parity value is the assumed fair value of the right that is derived from the market value of the share. So this is usually used if hindi available ang value ng right. So we have these two formulas. When the share is selling right on, so the market value of share right on minus subscription price over number of rights to purchase one share plus 1. And then when share is selling X right, so we have market value of share X right minus subscription price over number of rights to purchase one share. So to illustrate, we have a shareholder acquired 10,000 shares costing 2.5 million. Subsequently, the shareholder received a share right to subscribe a new shares at 150 per share for every 5 rights held. So the market value of the share is 210 per share. The right has no known market value. So if the market value of the share of 210 is right on, so we will compute it as follows. So yung 200, so we have 200 10, which is the market value of the share right on, minus the subscription price, which is 150 over 5, which is the number of rights to purchase, plus 1, which is constant. So we have 60 over 6, or 10 pesos per right. So to allocate the cost. So yung original cost natin is 2.4 million. Then I know rather, sorry. The original cost natin is 2.5 million. So the theoretical value of the share write-on is 100,000. So the remaining cost of original investment is 2.5. So the investment mo na lang, ang value niya is 2.4 plus the share write-on mga 100,000. Note that the market value of the share is 210 write-on, meaning this includes the value of the right, which is 10. Therefore, the value of the share X right, or excluding the right, is 200. So if the market value of the share is 210 X right, yung kanina is yung 210 right on siya. So if yung 210 is X right na siya, so we have this, we will compute the value of right as follows. So we have the 210, which is the market value of share right, X right rather, minus the subscription price na 150 over the number of right to purchase one share. So we have 60 over 5, or 12 per, 12 per right. So the cost of 2.5 million is allocated as follows. So yung original cost, we have 2.5, then i-minus mo yung share right, yung value ng rights, which is 120,000. So the remaining cost of original investment is 2,338,000. 2,380,000. So we have the illustration for not accounted for separately. A shareholder acquired 10,000 shares for 1.5 million. Subsequently, the shareholder receives 10,000 share rights to subscribe for new share at 100 per share for every 5 rights held. The market value of the share is 140, and the market value of the right is 10. Actually, given na ang value ng right. So the share right are all exercised by the shareholder. So the journal entry, upon acquisition, we have the investment in shares, then cash credit 1.5 million. To record the receipt of shares, memorandum entry lang tayo kasi nga it is not accounted for separately. Then to record the exercise of share right, we have the investment in shares and credit cash. So as you can see, upon the receipt is nag-journal entry lang tayo. And then if sold, binenta mo yung right mo. So if it is sold for 150,000, so the journal entry is cash 150 and investment in shares. So binawasan mo yung investment in shares mo. nag-credit ka kasi nga ano siya, it is accounted for separately. So that's it. Thank you and